Good afternoon, everyone. I would like to thank you all for attending our important webinar today. We at Qatar Stock Exchange are very glad to resume our market awareness webinars after a short summer break. We are proud to have Dr. Mark Mobius as our guest speaker. Please allow me to take this opportunity to express my sincere thanks and gratitude to him for accepting our invitation to volunteer his valuable time and priceless knowledge in today's webinar. As you may know, that QSE has launched its webinar series back in April as a quick response to the COVID-19 pandemic to ensure the continuity of delivering its market awareness programs without stop. In fact, QSE's mission to raise investments and market awareness is inspired by Qatar's 2030 vision, which seeks to build a strong national economy based on knowledge and economic sustainability. And this is most especially true for our young generations, as they have an important role to play in realizing the economic ambitions of our beloved country in the future. To this end, I would like to thank Dr. Mobius again and hope you enjoy our informative webinar. But before moving to our esteemed speaker, I would like to announce that QSE will distribute Dr. Mobius' book, Invest for Good, to our listed companies and market participants. Now I will leave the floor to my colleague, Mohsin, to start the questions.
Thanks for the introduction, Hussain, and I would like to take the opportunity to welcome Dr. Mark Mobius. He is no stranger to Qatar. I think he started investing when nobody was investing in the region and in Qatar. So welcome back to Qatar virtually. And today, as part of the program, we will be doing some Q&A with you. And the audience will be then requested to send in their questions also. They can send in their questions throughout the discussion as well. As part of the attendees, we have listed companies, we have market participants, research analysts, students from universities who were very keen to listen to you, Mark. As soon as we sent out invites, everybody started messaging, and they really are all thankful for you to join us and share your views, especially during these times. So I would head off with the first question, if you allow me. A lot has been happening in the last couple of years, more so in the last 6 months. And there is a lot or at least one very significant event expected in November with the looming US elections as well. So a lot is happening right now. The markets were going up, but then last week they changed their minds as well. So what's your take on this? How do you make sense of what's happening?
Well, thank you very much, first of all, for that very nice introduction. I appreciate your support and inviting me to this session. Of course, as you mentioned, there are quite a few things happening, and of course, most significantly is the COVID lockdown that is affecting the globe. Almost every country in the world has had real problems with COVID. I'm afraid that there probably has been an overreaction. I was 4 months ago in South Africa, and the reaction by the government there was very excessive. People couldn't even walk on the street because of the government lockdown. Then I was transported by the German government to Germany, and there the situation is a lot better. They allowed people to function and go to restaurants, of course, with distancing and with masks and so forth. And here in the UK, it's about the same. You can more or less function, but there has been an incredible impact on economies around the world. And of course, as you know, at the beginning of the year, February, March, we had a very big downturn in the markets. But as far as the American election is concerned, I've already stated that a loss by Trump would probably be disastrous for the US market. And you'd probably see a downturn in the US market as a result of that. As regards to the recent correction, you must remember that these markets have been going up almost steadily. Of course, the US market has been continuously rising at an incredible pace. And therefore, I believe that a correction was necessary. Of course, when you have these big rises, you always have some correction along the way. But it's interesting to note that it's really only the US market and a few other markets that have this correction of what, 7, 8, 9%. Many of the emerging markets have not come down at all. So it's not a global correction that we're seeing. So I would not be too alarmed by that. But I would say that the valuations are, of course, out the window, because when you have a situation with zero interest rates, then the traditional measures of value, like price earnings ratio, lose their meaning. So, for example, as an easy measure, you can just take the reciprocal of the interest rate to calculate the price earnings ratio. And if the interest rate is 1%, that means you can justify a price earnings ratio of 100 times. If it's 5%, then you can, the reciprocal is 20 times PE ratio. So the traditional measurements, therefore, are pretty useless at this stage. And of course, the focus is now on earnings growth and return on capital. And there are a number of companies that, of course, are quite good in that respect and have been doing quite well in the market. And then, of course, there are companies like Tesla and others who have no earnings to speak of, but yet are going up based on purely on sentiment, market sentiment. So that's where we are now. And I would say that it does provide an opportunity for people to get into assets, because with the amount of money supply, particularly US dollar supply around the world, hard assets, stocks, gold, land, etc., will be going up in value.
So with that, I mean, if I could just move to the next part of the question, where I mean, as you mentioned, the availability of dollar with quantitative easing and with Fed and EU central banks almost racing towards near zero or even negative interest rates in some economies. How do you see that impacting the emerging markets specifically? We've seen the impact on the US market.
Well, the impact on emerging markets has been very beneficial, because it means that emerging markets now, even those who were considered, whose bonds were considered junk, now are able to raise capital, because people are willing to take a chance. If they're not getting any interest in the bank, or if they're even having to pay the bank to keep their money, negative interest rates, then they're willing to take chances on countries which normally would not be considered. And therefore, the bond ratings really don't have much meaning in that case. So the market for so-called junk bonds is rising. And of course, more and more people will want to get into those.
So, I mean, has this COVID and this recent pandemic, obviously, and various other events in the market, has it had impact on your investment process or the methodology that you use in terms of investing or making investment decisions?
Oh, yes, very much so. As you know, in our book, Invest for Good, we emphasize corporate governance. And in the COVID-19 environment, corporate governance is extremely important because the way companies react to the COVID-19 situation really determines the future of that company as regards to such things as treatment of workers, treatment of customers, how they are governing their finances. Of course, balance sheet strength is extremely important. So a lot of these factors converge on corporate governance in general. And of course, ESG factors, the environmental, social, and of course, the most important governance factors become much more salient in this kind of environment, COVID-19 environment. So you begin to separate the men from the boys, so to speak, when you begin to look at these factors.
Hussain, you want to take the next question?
Yes, Dr. Mobius, thanks for the good insight. I get a question. How did you see Qatar market's resilience during the two crises in the last 3 years, the blockade and the pandemic?
Well, I think Qatar has been very resilient. Of course, market sentiment is reflected in the way the markets have moved. But generally speaking, Qatar has been very, very resilient in the face of all these difficulties and these challenges. And it's quite remarkable the degree to which the Qatari government and the people in Qatar have been able to withstand these challenges. So I think it's very encouraging to see that.
So, I mean, when you look at the region, and I think some of the fund managers also and investors who are on the call, they had specifically asked me to request, what's your view of the region when you look at the Middle East, Qatar specifically? I'm not going to ask you for your top pick in Qatar, but what's your investment thesis in Qatar, in the region?
Well, we continue to invest in the region. We, of course, have a few stocks in the portfolio. You must remember, our process is very focused and concentrated. We target no more than 25 stocks in our portfolio. So in order to get exposure to all of the markets around the world, emerging markets, such as China, India, Brazil, et cetera, of course, the Middle East should count for maybe 1 or 2 stocks of this 25 stock portfolio. Up to now, we've been investing in Egypt. We've been looking very, very closely at the other markets, Qatar, Dubai, etc. And of course, we continue to do that. We don't have any particular negative attitude towards the Middle East. We believe that there are tremendous opportunities in the Middle East, lots of very creative people, and most important of all, very good business people. People who've had long experience running successful enterprises. So we are continuing to focus on the region as well as any other emerging market around the world.
So if I may just extend this question further, because there are a lot of IR officers and CFOs and CEOs of the listed companies also as part of the attendees, what does it take for them to get into your portfolio? What do they need to do from an IR perspective,
Right.
from a liquidity perspective?
Well, first of all, we do look at the corporate governance aspect. In other words, do they have independent directors on their board? Very important. It doesn't mean, by the way, that we don't favor family companies with a lot of family members on the board. That's not a problem. But we do like to see some independent, 1 or 2 independent board members who can give if it's a family-owned firm, the family view, an outside view of the business and of the environment in general. So that's one very important aspect. Of course, in this day and age, we look at balance sheet. We want to make sure that the debt levels are relatively low, debt equity, let's say below 50%. And then we look at return on capital. Return on capital is very important for us. As I mentioned, the traditional price earnings ratio measure is not very meaningful these days with the interest rates the way they are, but we look at return on capital, and we'd like to see ROIC, ROE, ROA at 20% or so. And then, of course, earnings growth is very, very important. That's really what drives the markets. So these are the factors. Of course, there are many, many other factors we look at, but I would say at the first instance, these are the things we will look at.
And, does liquidity get into the discussion with your portfolio managers when you're looking at investing in the companies?
Yes, exactly. That's a very, very good point. We tend to want to have stocks that have at least, $1 million turnover daily. Otherwise, it's very, very difficult to get in and get out. So, of course, we've made many exceptions. There are many companies that we've looked at that have less liquidity than that, but usually the $1 million per day turnover is a number that we sort of focus on.
So, I just wanted to give a quick background to the audience that is joining us on the Qatari market. Of course, you have seen this growth because you have been investing for a very long time in the region. Qatar obviously has done phenomenally well in terms of the growth story, and the story continues with the World Cup being hosted in a couple of years' time in 2022, and then the LNG production capacity growing further by 2027 by almost 60%. So I think the growth story continues. However, I think there have been some other elements also that have been hidden. For example, the Sharia compliant stocks have even outperformed the conventional market because I think there are certain more filters or requirements when it comes to screening Sharia stocks. One of them is actually a stringent requirement on debt to equity ratio, as you were mentioning also, Mark. And there are a lot of small and mid cap stocks also in that particular index. And we do have an ETF also on both the indices listed on the exchange now. But
that's very good. By the way, the Sharia compliant stocks tend to align very nicely with the ESG, high ESG ratings. And of course, with the Sharia stocks, the balance sheet strength tends to be much, much better because of these strictures. So I'm not surprised to see that the Sharia compliant stocks do so well.
Yeah, but what has been, I think, phenomenal in Qatar or fascinating is basically the consumer sector growth, which has been the result of the diversification exercise that has been happening for the last 15 years or so. And with the Vision 2030, the economy or the consumer sector is further to be liberalized by more population growth in the country, with expats, white-collar expats expected to arrive not only for 2022, but also beyond that. So that's been interesting. However, I think going forward, you've seen Qatar embark on the journey from frontier markets to emerging markets. But then after that, we have been looking for a niche, and that niche is ESG. and that's where a lot of focus is there today. And perhaps, Hussain, you want to have a question on this particular area.
Yeah, I think, Dr. Mobius, I think the ESG is becoming one of the hottest topic nowadays. We held two events in regard to ESG, one with MSCI and one with FTSE Russell. So what is the importance of the ESG compliance to listed companies in terms of attracting more investment? And what would you like to hear from a company's IR officer on ESG?
Yes, it's very interesting to see what has been happening in recent years. The incredible increased focus on ESG. Of course, as you know, the environmental issues are at the top of the mind of many of the largest investment funds in the world. And then following that, they began to realize they had to look at the social aspects. In other words, if they were buying a garment company in China, what was the conditions of the workers there? Were they being treated fairly, paid accordingly, and so forth? And then these institutions began to finally focus on corporate governance because they realized that without good governance, in other words, without independent board members, without board members and generally the management looking at the environmental and social aspects, the companies was not going to do very well. And the numbers that we have, the studies that we have, indicate that companies that have high governance ratings, high ESG ratings as well, do much better in terms of stock performance than other companies. So this has grabbed the attention of people who want to succeed in the markets because they realize that if they are going to pick good stocks, they've got to look at the ESG ratings and particularly the governance. So that's been a big additional issue for the major investors around the world. And if you look at any major pension fund, any sovereign wealth fund, you'll find that they are looking at these factors very closely. And that's one thing we've recognized. All of our clients will ask us, what about the governance? And of course, what we do in our portfolio, we work very closely with the companies to help them improve their governance. Now, the interesting thing is that we found a number of companies have pretty good governance behavior, but no one knows about it. In other words, they have not really informed the public and informed their shareholders of what they're doing. So one of the first things we do when we talk to a company is advise them on how they can get the word out as to their ESG behavior. And I remember one company we looked at didn't even have an IR person. They didn't have an investor relations person. And that's one of the first things we said, look, you've got to hire somebody or you've got to select someone on your staff whose specific responsibility is to inform the public and particularly inform shareholders of what you're doing. So that's the kind of thing that we have been looking at very closely.
That's great, because as part of our strategy, Dr. Mobius, that's, you know, we always encourage our listed companies to improve their ESG reporting. So what would be the recommendation to our listed companies that you think that might really attract more investments to their companies?
I think it can be summarized in one word: transparency. In other words, it's very important for people, of course, without revealing trade secrets, but to reveal to their shareholders and to the public how they're running their business, being very transparent. And by the way, it doesn't mean painting a very beautiful picture. It also means telling people the problems and the challenges they face. People are very forgiving, they're very understanding, and the more transparent you are giving them information about the positives and the negatives, they will grow to like you and want to invest in your company. So I would say transparency is number one. And of course, when we talk about investor relations, transparency is uppermost in terms of the conditions that you have to enrich.
So I have a very interesting question from the audience, and the audience is usually very direct in their questions in Qatar. They don't like to beat around the bush. They're asking about what is the ticker symbol of Dr. Mobius's funds? How can they access your fund? You have already made an impression, I believe. So,
oh, thank you. Well, we have two funds actually. One is a Luxembourg CCAV. This is an open-ended fund listed in Luxembourg, and they can contact any of their banks or contact us, and we can tell them about how to invest in the CCAV. And then we also have a listed vehicle in London, an investment trust called Templeton Emerging Markets Investment Trust. So these are the two vehicles. I would recommend probably the open-end vehicle, because then they can exit and enter at any time at the net asset value. In the case of the trust, of course, it sells at a premium or a discount depending on what's happening in the markets. So that's another way of investing. But I would say the open-ended CCAV would be the way to go.
mm-hmm. And another question is coming our way is with regards to investor also who is already invested about 24% of their portfolio in a world Vanguard FTSE All World ETF, ex-US, and is asking for recommendations on emerging markets in terms of which ETF would you suggest, or which fund would you suggest?
Well, there are a number of ETFs, emerging market ETFs. iShares is one that's pretty big. Vanguard, of course, has one. There are quite a few like that, but iShares comes to mind as one of the largest and perhaps one of the most liquid. So that would be the way to go. But I would also recommend the investor to look closely at individual funds and individual stocks. If they, for example, if they have an account with Schwab or any of these brokers, they can invest directly into individual stocks that meet certain criteria. They have rankings, ESG rankings, debt equity, all these other variables they can look at. And then they can look at funds, such as the one we have.
Mm-hmm. So, I mean, based on your comments and what you mentioned about Sharia compliant as well, would a Sharia compliant ESG fund or an ETF be the best possible long-term investment vehicle for an investor, if there was any?
That's a very, very good idea. In fact, when you were talking about Sharia compliant funds, I was wondering whether there was one listed in New York and also one that has a CCAV in Luxembourg, because I believe that you could find a lot of people who would be interested in buying such a fund. I personally would be very interested in buying such a fund if it was easy to buy. One of the interesting things about this getting access to these funds is that many people find it very difficult because their bank refuses to sell certain funds. In other words, they have a list of so-called approved funds, and that's the only thing they will allow their clients to buy. So one of the big barriers, one of the hurdles that you have to overcome is that hurdle. So I would recommend, in the case of Qatar, that if they do have an ETF or a Sharia compliant fund, you approach some of these big banks like HSBC, Charter Bank, Bank of America, whatever one, and get on the list of recommended stocks, because I think you would find quite a big audience for such funds.
Well, I mean, I just want to have a different question, moving towards a different asset class. We've been talking about equities. In the COVID world, a lot of focus moved towards gold as well, and it rallied like never before. So, what's your medium-term outlook on gold?
Well, as you know, I've been recommending gold for a number of years now, and I've always said that at least 10% of a person's wealth should be in physical gold. By the way, I must emphasize physical gold, not gold shares, not a gold fund, but physical gold in the vault. I think is very, very important. The outlook for gold, of course, with the money supply avalanche that we're seeing, is still quite good. Now, I'm not recommending to rush into gold right now. As you know, it's gone up quite a lot. And I'm not predicting that gold price will continue to go up as much as it's gone up so far. But I think longer term, if you do dollar cost averaging, buying a certain amount of gold every month, you should do very well.
The government's also in the COVID, as a reaction to the COVID situation, reacted with the stimulus and a number of actions. The Qatari government announced also 75 billion riyal, or almost $20 billion package for the SMEs, and a 10 billion riyal, close to $3 billion support fund for the market. When you see such announcements from various governments, does that provide you comfort, or does that provide you, is that repulsive because you don't want intervention?
Well, of course, you know, when the governments come in to provide aid in the times of emergency that we're seeing now, it's generally a good thing. In other words, you're supplying money, particularly to the small and medium enterprises that really are in deep trouble. But the ultimate solution is to end the lockdowns. I would say we're at a situation now where if the lockdowns do not end soon, you're going to see a lot of public strife and violence globally, because people are quite desperate, particularly in the lower income groups who are living from day to day. Being in a lockdown situation is very, very difficult and onerous. So I think, number one, governments should, as soon as possible, open up their markets, allow people to travel, allow people to move. Of course, you can have your masks and you can have your distancing, but as I mentioned, I've been traveling from South Africa to Germany. I was in Portugal, I was in Italy. I don't see any problem in being able to move about as long as you take certain precautions. So I think number one, okay, temporary help is good, but the ultimate solution is to open up the markets.
Yeah, and I mean, the country also here in Qatar went into a lockdown back in March, but gradually started to open up in June, and then now it's fully open. Kids are back in school as well, so that's already starting to show a good sign in certain sectors. We saw the results also, especially the consumer sector, the food sector, which did very well. We're seeing one more question from our attendees. It's a IR officer from a listed company. What ESG reporting framework do you consider as the new ESG reporting standard? For example, BlackRock CEO has mentioned Sustainability Accounting Standards Board and Task Force for Climate-Related Disclosures. So what do you prefer when you're looking at the ESG reporting standards?
I would say all of the above. It's very, very difficult to focus on one. He mentioned the Sustainability Index. The MSCI has one. There are a number of indices measuring ESG factors, and none of them is perfect. But I would say the way to handle it is to use 2 or 3, just to get some comparability and some credibility if you're trying to do one for your own company in terms of looking for scores. Now, in terms of introducing ESG factors, then the United Nations list of sustainability factors is probably the most comprehensive. It's a checklist. You can go down the list and check the boxes on every single factor related to environmental, social, and governance factors. But then at the end of the day, it's very important to try to get one of these organizations, whether it's MSCI or sustainability or whatever, to come into your company and do a correct evaluation.
So you recommend that corporates do talk to people like MSCI or FTSE to get as high a score as they can, or ratings in those indices.
That's right, yeah.
Right. So, and do you have your own methodology also, or you would rely usually on for initial screening?
We have our own methodology. We have our own checklist. But of course, our focus is more on corporate governance. What we do is we say, okay, is this company doing anything in the environmental sphere that would disqualify them from our view? So generally speaking, we don't invest in mining companies, in companies that obviously have risk as regards to the environment. Then on the social side, we then look at their business to see if there are any possible factors at work, but our focus primarily on corporate governance.
Right. I mean, I think your comment on gold has triggered a lot of excitement at the Q&A board. So I'll read a couple of questions out from there. Why is it important to have physical gold? Does it also mean a physically backed gold ETF? Or you are suggesting the actual metal in my house?
Yeah, the reason why I talk about physical gold, and of course, the way I do it is I have physical gold kept by my bank in my account, separated from everything else. The reason why I mention that is that in the past, the history, we've learned that governments tend to take gold away from people in times of crisis. So it's a good idea to try to get some gold which is not within the reach of a government. And so that's the reason why I mentioned physical gold. Of course, if you have gold in the bank, the government could probably get that, but I also keep gold in the safe deposit box. So it's a good idea to keep it in that way, that's safe from any government that wants to take over the gold assets. This happens, by the way, I'm particularly thinking of the United States. As you know, in the past, the United States government has taken away gold from the public, and other countries have done the same thing. I think in the Middle East, it's probably quite unusual because the governments tend to respect gold holdings.
Yeah. So in that context, in the Middle East, a physically backed gold ETF, would that make sense from a logistics point of view, or for
yes,
an investor?
Yes, it would make sense. But again, this is very important to remember. You must look very carefully at the organization controlling the ETF and make sure that there are proper audits of the gold holdings. Because there have been cases in the past where certain gold funds didn't really have the gold.
Physical gold, yeah.
And that created a big problem. So you got to make sure you're dealing with very reputable people who have independent audits of the gold holdings of the ETF.
Yeah. No, I think that's all governed obviously by the regulations, where an independent entity is required to custodize the gold as well, whether it's onshore, offshore. But there is, as you said, it's important that the regulations also provide that protection to the end investors. Uh, there are a few more questions from the audience, but before I go there, Hussain, you wanted to have a question?
Yeah, I would like to focus on the education. Dr. Mobius, one of the main pillars for our country and for the exchange is education. So we do a lot of education seminars through the year. What is your main advice to investors, especially for the young generations?
In terms of education for the investment markets, stock markets, bond markets, etc., I think it's very, very important to get access to the leading books on these subjects. And by the way, as you know, many, many books have been written about stock markets, bond markets, etc. Of course, the classic book on value investing, as you know, has been there for quite some time. But I think you've got to encourage students to read more widely in view of the recent circumstances and changes that have taken place in the market. So there have been a lot of popular and very interesting books written recently about markets, which I would recommend highly. But also, I think it's important to read widely history. Try to read as much as you can about history, the background. For example, I've just been reading a book about accounting, the history of accounting. Double Entry is the name of the book, a very interesting book. And it goes back to the Italians, the Venetians, who introduced double entry bookkeeping. And of course, interestingly enough, for the Middle East, of course, the Venetians learned it from the Middle East, as you know. Previously, the people in Europe used Roman numerals, and it was only when they learned the Arabic numerals, and of course, the Middle Eastern people had been using double entry for quite some time before that. This is the kind of background and history that people should learn about as much as possible. So another interesting book is a book I finished called Bean Counters, a very interesting book about accounting firms and all the problems that they have. And by the way, that is one of the biggest challenges we have, as you know. When we look at companies, we have audited accounts, but can we trust the auditors? This book, Bean Counters, illustrates how the auditors have often been in bed with the company management and have fixed the books. And this has created some of the biggest accounting scandals in the world. Enron, you know about, a number of others like that, which were caused by auditors who didn't do their job. So I think you've got to get the students to read as widely as possible about the markets.
So I think we are, I'm conscious of time also, but we keep getting very interesting questions. People actually, I think, want to get a real tip from you. So let's, one of the very, I think, experienced investors in the market has asked, in terms of equity investing, which country do you like at this moment the most, and which sectors do you like during this pandemic crisis?
Right now, if you look at our portfolio, you'll see that India is the largest weight in the portfolio, followed by China and Brazil. And of course, a lot of this is driven by liquidity. We probably would want to have more in other countries, but the liquidity is not available. We also have investments in Turkey, in South Africa, in Korea, Taiwan. Those are the main ones. So I would recommend people look at those countries to begin with, in addition to the Middle Eastern countries and Qatar. In terms of sectors, our interest to begin with is education. We have holdings in the education sector, in the health sector, particularly in health testing. That's an area that we're involved in. And in India, for example, we have companies that are looking at infrastructure supply. In other words, companies that make things like pipes that are used in infrastructure investment. So those are the ones that we are looking at most closely at this stage. And then in addition to that, of course, the electronics area. As you know, the demand for semiconductors continues to rise. The use of the cloud is exploding, and that means more and more memory chips and semiconductors. So in Taiwan, we've invested in companies that do the software and integrated circuit design for these semiconductors.
Great. In terms of this pandemic, I mean, we have seen how things changed around Zoom. So, I mean, and you mentioned education and health. So is ed tech or health tech, is that an area also that you are looking at, or it's still too early?
Oh, very much so. I think one of the interesting things that we're seeing globally is the introduction of technology to every field, regardless of what field you're in, whether it's be retailing, medicine, mining, construction, whatever, retailing, you are going to have to be au fait and knowledgeable about software and the use of the internet. So one of the first questions we ask companies is that, okay, what are you doing about the internet? How are you using the internet in your business? How are you using technology in your business? Because those companies that are not capable of grasping the opportunity offered by technology will have real problems going forward.
So, I mean, you have over 40 years of experience in investing in emerging markets. And when investing in these markets, and it's a question from one of the attendees as well, how do you manage the currency risk when investing for long term in these emerging markets, like, for example, Turkey? How do you?
A very, very good question. Excellent question. Currency is one of the biggest challenges that emerging market investors have, because for the most part, investors are thinking of US dollars. So when they look at the depreciation of the Turkish lira or the Brazilian real or whatever, they get very frightened. They say, God, you know, I'm going to lose all my investment with the currency devaluation. So what we do is we look at, first of all, what is the impact of the currency on the individual company? For example, let's talk about Turkey, because that's a very good example of where the currency has devalued dramatically. By the way, the Turkish lira has actually gotten stronger against the US dollar recently, but anyway, it's had a tremendous devaluation. But what we did is we invested in a company that had overseas earnings. In other words, earnings in dollars. They were exporting their software to other countries, and therefore were able to actually benefit from the weak currency because their costs are in Turkish lira, but their income is in US dollars. So that's one way to handle the currency risk. We've looked at in great detail the possibility of doing currency hedging, but we found that doesn't work because currency hedging is very expensive, particularly in a currency that is so vulnerable like Turkish lira or the Brazilian real or any of these currencies that have a weak macro environment. You cannot easily hedge. It would be very expensive. So we find that this so-called natural hedge, where you're picking companies that will benefit from the currency devaluation, is the best way to handle it.
So I think we're coming to the closure of the discussion now with the eye on the clock. A couple of more questions, and then maybe we can move towards closing remarks. On liquidity, you obviously have been traveling everywhere in the emerging markets. You've traveled the region also. You've met the market authorities, the regulators, like stock exchanges, the pension funds, sovereign wealth funds. How do you advise the governments or the market authorities to help build liquidity in their markets? Because as you mentioned, that's one key criteria for you when you start to make the decision on investing in a particular country.
Yes, I believe that one way to do this, and of course some countries have done it, they've said in order to encourage the local companies to be listed, they've given certain tax benefits to those that list their stocks. I think this is a very good method. Of course, some governments say, wait a minute, we're going to lose our tax income. But if you find that so many people have been evading taxes, if they get listed, they have to reveal their accounts. So there's a certain disadvantage for these companies to be listed. So it would make sense for the governments to give them maybe a 20% discount on their income tax or their profits tax. That's one way. The second way is that if you look at countries around the world, you'll find that the largest companies are the state-owned companies. So one way to increase liquidity in the market is by having state-owned companies being listed. Now, of course, many people will say, wait a minute, we don't want to sell our crown jewels to the foreigners. But the answer to that is you don't have to sell all the stocks. You can take 5 or 10 or 15% of the assets and list that portion of the share capital. You still are controlling the company, but then you have a number of benefits. You have much more transparency because any investor will demand transparency. And you also have much more focus on profitability. So many governments have benefited from listing their stocks on exchanges. And probably the best example of that is China. If you look at the major Chinese government-owned companies, government-controlled companies, you'll find that many of them, if not most of them, are listed.
So I'll move towards the last question for today, and then we can have closing remarks from all of us. In terms of the technology sector, do you think it's too late for investors to get into tech sector in the US market, like Tesla or the FANGs, or do you think the market levels are sustainable at still this level?
Well, it depends on which stocks you're looking at. First of all, let me say this. It's a good idea to get involved in technology. There's no question about that. And it's a good idea to get involved in internet-related companies. But that doesn't mean that you have to invest in Tesla or Apple or any of these giants whose stock prices have gone through the roof. By the way, one of the interesting issues, I don't know whether you've read about this, about the involvement of derivative instruments, puts and calls on these stocks, which have driven the market much higher than it should be. So I would recommend to people to be very cautious and make sure that you follow some fundamental guidelines. Now, I know we all have been wrong about Tesla because Tesla looked like it was going to go bankrupt, and yet the stock price has gone through the roof. That's fine, but you don't have to go there. The best way to evaluate your tech companies is to find out if they're earning any money. And if they have growing earnings, growing cash flow, you must look at these fundamental factors and don't get carried away by the sentiment in the market, because if you do that, you can get very much hurt by a decline that is unexpected and is not going to be corrected easily.
Sure. And you think the levels in the global markets with all this money being injected from the central banks, is it likely to remain sustainable in that context?
No, of course, it's not going to be sustainable. Eventually, governments around the world will want to hold back and pull back on the amount of money supply they have. They will perceive so-called inflation coming up, and they will want to pull back. So you've got to be very careful. The Fed, of course, is already talking about the possibility of raising rates. So you've got to be very cautious in that regard. Don't depend on central banks to continue to feed the markets. By the way, one of my concerns is the whole issue of inflation. I believe that inflation is not a very good measure to determine government policy. And in fact, we are living in a deflationary world where productivity is going up and prices in real terms are going down. So given that situation, you have to really focus on margins, return on capital, and growth in earnings.
One fun question at the end from a research analyst. When is the next sequel of Team Mobius comic book coming out? I think he's following along.
Well, you know, a few years ago, we did another, the comic book he's referring to is probably the one that was done in Japan. It was a manga, so-called manga, and it was translated in a number of languages, including English, and in fact, Arabic. That comic book is in Arabic as well. But there's another comic that I've done, which is sort of designed to educate people about risk and about being too heavily leveraged. And that comic will be on my website, I think, soon, so they can read it for free.
Okay, well, Hussain, that's for you. If you want to have some conclusion remarks, then we can move to Dr. Mark for the last comments.
Yeah, I just would like to go back to Dr. Mobius' insight about IPOs. Here at QSE, we feel the challenge. Today we have 47 listed companies, and we feel that it's a small number. So we want to improve and increase the number of the listed companies. You touched on the incentives that might attract more listed companies, whether it's a family-owned company or government as well. So what would be, or what do you think that would be the best, let's say, incentives to incentivize those companies to come in to the market?
Yeah, that's a very good question, Hussain. I believe that one of the first things that can be done is, as I mentioned, some kind of a tax benefit to being a listed company. Because as I said, being listed means that you reveal your accounts to the public and to the government. And many companies have been very reluctant to do that for a number of reasons. So I would say some kind of tax benefit would be good. The other aspect would be to launch some education to companies, particularly family-owned companies. I think many family-owned companies where the patriarch, the founder, is nearing the time of retirement and is wondering what to do in terms of passing on his business to his family. Now, some of the family members may not be interested in the business. So by listing the company, what he can do is have professional management and then divide the shares among the family members so they benefit from the company, but they don't have to get involved in the management. And of course, by being listed, there'll be much more transparency for all the family members, and it would make a lot of sense for these companies to do a listing.
Okay. Any last thoughts for the audience that you would like to leave with us in terms of, listed companies primarily? What would be one word that you want them to remember?
Well, I would say, number one, be optimistic. Don't be pessimistic, because in the long run, markets will do well. In the long run, if your company is being operated properly, it will do well. So first and foremost, don't be so frightened about what you read in the newspaper or what you hear on the internet or wherever. Be optimistic, and of course, look very closely at corporate governance.
Well, thank you, Mark, for your time and extremely beneficial insights. I think we have never seen this kind of interaction from our audience and the questions and answers. There was very keen interest in, and I'm sorry if there were some direct questions, but I think it's something that you encourage also. So thanks for that. And thank you, everybody. We will be back soon again with, I'm sure it will be very difficult to beat this event, this webinar that we held. But we will be back with another one going forward in this month to discuss various ETFs with our investors. So thanks once again for joining us. Thank you, Dr. Mark Mobius. Thank you, Hussain. Thank you, everybody.
Thank you. Thank you very much. Bye-bye.
Bye.